the mic on? Is this mic on? I was just going to get everybody to sit down. Pardon me? Yeah, it is. Could I ask everybody to find a chair, and we'll get started with the meeting right away? Thank you. Are we ready to go? I would like to welcome you all here this evening to the public meeting of the Saskatchewan Rate Review Panel on the rate application from the Saskatchewan Auto Fund. Before I start, I would like to acknowledge that we are meeting in Treaty 4 territory. This is the original territory of the Cree, Saulteaux, Nakota, Dakota, and Lakota First Nation, and the traditional homeland of the Métis. My name is Albert Johnston. I'm the chair of the Saskatchewan Rate Review Panel. The panel consists of 7 members from across Saskatchewan, and I would like to introduce them to you. Our vice chair is Delane Barber from Weyburn, right over there. Also Dwayne Hayunga from Prince Albert, right there. Glenn Duchak from Kenora. Kim Hartle from Lake Lenore. Bonnie Guillou from Saskatoon. And Keith Moen, also from Saskatoon. I would like to start by outlining the format of the meeting. We will start with a presentation from SGI on their rate application, and I will introduce them in a moment. Secondly, I believe Alana Young is here to make a short presentation. As most of you may know, Alana is the MLA for Regina University, and as well she's the NDP Deputy House Leader and critic for SGI, amongst others. Following that, we will have presentations from 2 of the taxi groups, Capital Cabs and Regina Cabs. And following that, we will have presentations from 2 of the motorcycle representatives, John Hanson from the Motorcycle Coalition, as well as Don Fuller from RAGE. I think what we will do is we will have the SGI presentation. We'll hold questions then until after you've heard from the motorcycle group. So unless you really had a burning question that you wanted to ask, we would hold all questions until the end. We'll allow questions, if there are any, after Elena has spoken and after the taxi people have spoken. So that's kind of the agenda for the evening. So I'd just start out by introducing Jeff Steppen. Jeff is the CFO at SGI, and I will let him introduce the rest of his compatriots up here. So, Jeff.
Thanks, Al. As Al mentioned, I'm Jeff Steppen. I'm Chief Financial Officer at SGI. I'll be sharing the presentation with Chris McCullough. Chris is our Vice President and Corporate Actuary at SGI. Also at the head table is Penny McCune, who is our Chief Operating Officer for the Auto Fund, and Quay, who is our Vice President of Traffic Safety for the Auto Fund. Also scattered in the audience are a few other subject matter experts from SGI who may pop up to answer a question if their expertise is needed. So, okay, I'm going to start off just by talking about the auto fund mandate. And the auto fund mandate is to break even over time. That is to collect enough premium revenue to cover claims and expenses and to maintain adequate reserves. The other key mandate for the auto fund is to ensure fairness in rates. And what that means for us is that each class of vehicle is paying enough in premiums to cover their claims and expenses, not too much and not too little. And very importantly, this is a public fund for motorists. The government put no money into the auto fund, and they can take no money out of the auto fund. So right now, the auto fund is collecting enough premiums to break even, so hence the 0% overall rate change for the auto fund. But individual classes of vehicles aren't paying enough or are paying too little, and that's why you see some classes are going up, some classes are going down. They net to the overall 0 rate change. So there are two components to the rates. We have the basic insurance rates that covers the claims and expenses, and then we also have a capital component that makes sure that we have adequate capital in our reserves, in our rainy day fund. Overall, claim costs have been increasing for the auto fund, and because of that, we have to increase the base insurance rate by 1.7% to offset those increasing claim costs. But we have enough capital in the reserves so we can actually reduce rates by 1.6% to compensate for the fact that we have that the adequate level of capital. And with rounding, all of that nets out to the 0% rate change overall. Couple of points here on the operating philosophies for the auto fund. First off, we're providing basic auto insurance, and that basic insurance has to be universal, and that means it's consistent, comprehensive, and it's applied evenly for all customers, and fair, and that means that that all customers are treated the same. Second point there is to fairly rate vehicle classes based on how many at-fault claims they have. So again, looking at history to predict what we think the future might be for claim costs and collecting enough premium to cover those claim costs and expenses. And the last point is important as well, and that's to keep rates as low as possible. One of the key factors on our balanced scorecard is that we have one of the 2 lowest rates in all jurisdictions across Canada. Right now we have the lowest rates, but we want to make sure we're in the bottom 2 in terms of overall rates. So what do we provide? The basic insurance coverage that we provide is defined in the Automobile Accident Insurance Act. The 3 basic parts of the insurance that we provide is personal injury benefits. So that means that anyone who's injured in an automobile accident will be taken care of. That means income replacement if they're not able to work. That means medical, rehab, house modifications, physio, chiropractic, that sort of thing. For those customers who are catastrophically injured, that means we may be paying for them for the rest of their lives. So we have to make sure that, again, we're collecting enough in premium to take care of those customers who are catastrophically injured. Also, third-party liability, and what that means is that somebody who is at fault, we will cover their costs for damage to other people's property or injury to other people. And of course, we have the physical damage to the vehicle. We will repair vehicles, or if a vehicle is totaled, we'll provide funds to purchase a new vehicle. So I'm going to spend a little bit of time going over a financial overview, and it's been a really interesting time for the auto fund. What we're showing here is the last 5 years of results for the auto fund in a very summarized fashion. We have a March year end, so the periods here begin April 1st and end on March 31st. Start at the top line, so that's net premiums earned. You can see that's about $1 billion in premiums that we collect every year. Total claims and expenses are consistently more than what we collect in premiums. We do that on purpose. Because we're trying to break even over time, we lose money on the business of insurance. So premiums collected, less claims and expenses, we lose money. It's called an underwriting loss. We do that knowing that we're going to have investment income to offset those underwriting losses. But because of the volatility in the investment markets and because of the volatility in claims, we're never going to get it right. You can see here in the last 5 years, we've made money in 4 of 5 years. We lost money in 1 year. The one thing to note here is the last year that we're showing, the 2020-2021. You can see investment earnings where they had been around $100 million or so. We have a portfolio of about $3 billion that we're investing. So investment income was between $1 and $200 million, except for 2020, where the investment markets collapsed. We basically broke even on investments. But then in 2020, 2021, we had investment earnings of $500 million. So that's what precipitated the results for us to be able to enhance benefits as well as provide a rebate to all of our customers of $285 million, and I'll touch on that. So you can see the bottom line there, the rate stabilization reserve and the increase or decrease to the rate stabilization reserve, and you can see that has grown over time. That will continue to grow over time as our liabilities grow and our assets grow to offset those liabilities. We can't just keep a consistent amount of capital. We have to have that capital, that rainy day fund, grow as the size of the business grows. So I talked about some significant changes, and in the last year, because of the exceptional results that we had in investments, we were able to enhance injury benefits, and this effective May 1st, 2021, we increased the amounts available for living assistance. And again, this goes to our most catastrophically injured customers. So we increased the maximum weekly benefit for things like dressing, bathing, cooking, cleaning, yard care, things like that. We were also able to increase the income benefits, the income replacement benefits. The standard practice in the industry is to offset any income replacement benefits that you're getting by the amount of Canada Pension Plan that you receive. So once you start receiving Canada Pension Plan, your income replacement benefits would reduce, so you're getting a consistent amount over time. So we stopped doing that, so overall, these catastrophically injured customers, their income replacement benefits would be higher over time. So again, in addition to those improvements in the injury benefits, we were able to provide a rebate to customers of $285 million, and that amounted to about 26% of your average annual premium that you paid over the last 3 years. I talked a little bit about the need for a rate stabilization reserve. So in addition to protecting customers from sudden large rate increases, it also ensures that the auto fund can meet its claim obligations. I talked about the volatility of claim costs, the volatility of investment markets, and the fact that we're taking care of some customers effectively for the rest of their lives. And that means our liabilities are extending out over 50 or 60 years. So just making sure that we kind of just have enough isn't good enough. We have to have, by actuarial standards, by industry standards, we have to make sure that we have enough in reserves to cover off those liabilities. Back in 2014, we didn't have enough in the rate stabilization reserve, and I'll show you a slide here in a minute on that. So then we added 2.2% in rates to slowly build up that capital amount over time. Now that we have enough capital in the rate stabilization reserve, we can start backing off on that. But why don't we back it off right to zero? We don't just get to decide how much capital we have in the rate stabilization reserve. There's industry standards and models that we use to decide how much our capital levels should be, how much would be appropriate to hold. The insurance industry uses a measure called the minimum capital test, and I'm not getting it into it. It doesn't mean much other than to geeks like me and maybe Chris. But the target for the auto fund is an MCT, a minimum capital test of 140. And again, that's not going to mean much to you, but I'll show you a slide of why that means, what that means. As I mentioned, the capital amount that we've got built into rates is 2.2%. We only need 0.6%, so we're able to reduce rates by that by the difference, or 1.6%. So I talked about the available capital, and that our target is an MCT of 140. You can see the red line on this chart. That's our target level of capital. And back in 2005, 6, 7, we were at that level until the investment markets crashed in 2008, and again in 2011. And you can see how quickly that changed from us having a very strong capital position to being sufficient or significantly deficient in our capital level. So we, again, adjusted rates, increased rates, and you can see from 2013 on to 2019, 2020, we finally eked above our target level. And frankly, the markets went crazy. We didn't anticipate earning the kinds of returns that we did. We enhanced benefits, we did the rebate, and we continued to earn more on investments. And that's why you can see the result that we're at now, where we're frankly well above our target capital level. But again, that is we're in a tenuous position in the markets. The markets are very volatile, and you can see how quickly that can drop. So we're happy with the capital level that we're at now, and we're cautiously optimistic that we'll be able to maintain that. So I'm going to stop there. Chris is going to get into the details on what the rate application means and how we got into, or how we calculated the individual rates. So, Chris.
All right, thank you, Jeff. So as the auto fund's actuary, it's my role to measure exactly how much premium is needed to offset the claims and expenses that we expect to see in the auto fund. So there's three major components to that exercise. The first is measuring that overall level of adequate premiums to break even. And the second would be fairness in rating, which is drilling that down to individual vehicles, making sure that each one is paying an appropriate rate for the risk that it has. The last component is maintaining adequate capital, which Jeff has spoken to already. So my presentation here is focusing on those first 2 points and going into the details. So as Jeff mentioned, the overall rate increase is a 1.7% if we're looking to just break even. And that's a few main factors. In fact, there's a lot of factors, but I'm covering the major ones here. We're seeing improving overall injury claims experience, which actually serves to reduce how much premium we need to collect, but it's being more than offset by rising overall damage costs and increases to the expenses in the fund. Overall, after reducing capital, the capital margin component, this turns out to be that 0% overall change or revenue neutral. So digging in on that first component first, the improving overall injury trends, I'm speaking here on an overall basis. Now this can and will vary for each class of vehicle, and we'll be talking to motorcycles and some other classes a bit later on. But back in 2014, the last rate application we came forward with, the trends on the left for each one of these different coverages of injuries, this is how much we were seeing them increase year over year. Medical benefits, income replacement benefits, death benefits rising by 4% or more every year, care benefits or living assistance benefits staying relatively flat. Today, many of those trends have turned completely around. Income replacement benefits and death benefits are declining at 4 to 5% year over year, and medical benefits have flattened out, and care benefits have also become negative. This is a very, very good news story for what we're seeing in the province of Saskatchewan. And what this means, instead of just numbers, is it means fewer people getting injured or dying on Saskatchewan roads every year. And it's a fantastic thing for them and their families. In terms of the auto fund specifically, it means the auto fund pays out less in these injury claims, and it means it needs to collect less in premium to help offset those costs. Now, what could be causing this? There could be a number of things, but there have been a large number of traffic safety initiatives put in place by SGI over these years. And on top of that, there's also a lot more focus on impaired driving. There's been new laws and increased enforcement of those to enforce the laws. There's also better and better safety features in vehicles every year. You can see a lot of new features in new model year vehicles that serve to protect everyone in them. Offsetting these costs here are rising overall damage costs year over year. We are seeing repair costs increasing at a pretty dramatic rate, and it's due to the increased complexity of the technology that's now present in the vehicles, the procedures and the materials that are needed to be able to make those repairs. Those same advanced safety features that are causing reductions in the cost of injury claims are far more expensive to repair when there is a crash. Something that used to be a very simple bumper replacement before, well, now there's sensors, cameras, and a lot more technology in those bumpers that need to be replaced and calibrated. And those costs are a direct increase for the auto fund. Looking at how much it costs to repair from a collision in a light vehicle, generally private passenger vehicle, we can see that what used to cost less than $4,000 per crash on average 5 to 6 years ago now costs over $5,000. And this is well above the level of inflation, and as you can see here, it's incredibly consistent, increasing over time. I want to speak briefly to the effect that the COVID-19 pandemic has had on the claims experience of the auto fund. So we've seen over the past year and a half a noticeable reduction in the number of claims that are being reported. But this effect wasn't uniform over time. It wasn't even. What we saw is when there was periods of significant restrictions in place, we saw a significant reduction in the amount of claims being reported. But as those restrictions were lifted or removed, the number of claims reported to SGI raised back up toward the basic level. And what we're seeing now in 2021, as more restrictions are removed, that we're seeing that number of claims rising back up toward the normal long-term level we'd seen before, such that in the rating year of 2022, we don't expect there to be any effect left at that time. The one assumption we do have in the rate program here is an assumed impact on commercial vehicles, such that the prolonged impact that the pandemic would have on the economy would reduce the number of vehicles that would be reported or registered in 2022. And that's a 5% reduction, which affects both their premium and claims assumed. So I've kind of spoken more so than anything else to that overall level of premium to break even, answering that first question from my first slide there. Now we're going to dive a bit deeper into individual vehicle rates. How is it that we measure the specific rates for a vehicle within each class? And it's no easy feat with over 30 classes of vehicles in the auto fund. Each class has its own rating characteristics too. The variables specifically that we've seen are significant in predicting its risk. Something like the number of seats on a bus, which helps predict how much it'll cost to repair or how big of a claim it can have when it crashes, is a useful one for buses, but it's completely pointless for motorcycles. Motorcycles on their part would be significant with something else that we've seen, such as engine size. And I've got some more details from that later, showing how that is a significant predictor of how severe an injury can be. Now, we don't want to change rates by too much in each individual rate program, and so we have a rate capping process in place. For most vehicles in this rate program, we're proposing a 15% cap on how much rates can move up or down, and that would be for all vehicles with premium of $1,000 or greater. Other vehicles with premium below $1,000 would have a cap according to this chart here. Right now in the auto fund, only 21% of all vehicles are paying a rate that's adequate or correct for their level of risk. With this rate program and this capping schedule here, we're going to move to have as many as 93% of them paying that adequate rate. Even with this rate program, some classes of vehicles still won't be paying an adequate level. I'm highlighting a few of them here. Motorcycles, motorhomes, and taxis will all still need 70% or more of their vehicles to have future rate changes to be able to get to that adequate level that they should be at. Personal trailers get about halfway there with this rate program, and I'm contrasting that with private passenger vehicles, our largest group, which over 95% will be at their adequate level after this rate program. Next, we're going to dig in on some of the individual vehicle classes, and we'll start off with motorcycles. Specific for motorcycles, we have an indication of an increase needed of 34% so that the premium would align with the claims and expenses that's expected for the group. So what this means after capping is 10% increase. Individually for motorcycles, 88% would see increases, 12% would see decreases. Since the last rate program, we did put in place the option for motorcycles to have a reduced no-fault coverage level in exchange for a discount applied to their rates. And we're not proposing to change the level of those discounts at all in this rate program. What we are doing with this rate program is better refining the engine size and model year grouping categories, making more of them, so that your motorcycle won't be slotted into a larger group with a lot of other ones to determine its rate. It'll be a rate that's more specific to its characteristics and its level of risk. From here, I'm going to talk a bit about the history of motorcycle claims and their rate need, and then speak a little bit about how we categorize claims for pricing, engine size as a category, and some comparisons of rates to other provinces. So first, looking at the history of motorcycle claims. We have here the amount of claims paid out in blue bars for motorcycles in each of the past years in the decade here. The yellow line is the premium we've collected from motorcycles. I haven't even included expenses on here, so the yellow line would have to exceed the blue bars for it to break even, and we can see that for most years it hasn't. The notable exception is 2016-2017, where right after the motorcycle initiatives were put in place in 2015, we saw this noticeable decline in the number of claims. However, since that time, 2018 through 2020, we see worrisome trends. The amount of premium collected per year is declining at the same time as the amount of claims we're seeing per year is rising. So this is a concern, and it's given rise to the rate increase that we've come forward with today. In the history of motorcycles, there's always been a shortfall in terms of how much premium is being collected versus the claims and expenses that we expected to see. But it's improved over time. You can see that going back to 2009, that shortfall was $17 million. That's how much we were expecting other classes to subsidize motorcycles at that time. But with the number of the measures that have been put in place since then, that shortfall has declined through those rate programs over the years, all the way down to only $2 million today. And those measures were the 2015 initiatives were put in place, but also the 2012 through 2014 rate increases. The point is that shortfall, that the rate increases have worked, and so have the initiatives, and we're very close to getting there. But we believe that another rate increase needs to be at least part of the solution for the motorcycle class at this time. Next, I want to speak a bit about fault allocation, or loss transfer, as it sometimes is called. This is how we categorize claims as part of the pricing work when it's a crash between two different vehicles of different classes. So what happens is, for both damage and injury costs, we tie them all to the vehicle that is at fault for that collision. This changed as part of the 2012 rate program, and at that time, for motorcycles specifically, it shifted as much as $30 million of past losses away from motorcycles to other classes of vehicles. So this change was already made, and it did have an impact on that shortfall that we were just looking at. But even with that adjustment, that $2 million today shortfall remains. The reason why this change was made was to uphold SGI's mandate of fairness in rating. We do believe that if a vehicle is at fault for the accident, that it should be the one charged for the cost of that accident. I have some examples to run through here for how this works, just to drive the point home. If there's an instance where a collision occurs between a private passenger vehicle and a motorcycle, and the private passenger vehicle is at fault, in this example making a left-hand turn into the path of a motorcycle and judged to be at fault, all costs from this accident would be tied directly to the private passenger vehicle. That's all the damage costs and all the injury costs of anyone involved in the entire accident would be charged to the private passenger vehicle. $0 would go to motorcycles. Another example, if a collision occurs in an intersection where a motorcycle is making a right-hand turn and fails to obey a stop sign and ends up colliding with a private passenger vehicle, In this instance, the motorcycle would be found 100% at fault, and all cost of the accident would be tied to the motorcycle. $0 would go to the private passenger vehicle. This is what we mean when we say fault-based cost allocation. A third scenario involves a collision between wildlife and a motorcycle. And in this example, even if the motorcycle is found not at fault, all the cost of this accident, damage and injury, would stay with the motorcycle class because it was the only vehicle involved in the accident. So we've heard some questions before from motorcycle riders about the use of engine size as a rating variable and whether that truly is predictive of risk. I have here a summary of the history that we've seen for the severity of injury claims. In other words, the average amount that an injury claim costs SGI depending on the motorcycle that the person was riding. And we can see that for the smaller engine size motorcycles, up to 300 cc's, that's an average of $40,000 for the injury. That climbs, as the engine size climbs, all the way up to an average of over $160,000 of injury costs for SGI for the highest grouping of 1,100 cc's or larger. So this is what we mean when we say the variable is significant. It's consistent in the history, and it does predict how much and how severe that injury would be. I'm going to move on now to comparing between SGI and other provinces. Now, one of the major differences in rates, or what explains the differences in rates, is coverage levels. In Saskatchewan, I'm focusing here on income replacement benefits and the other more general rehabilitation benefits that are medical and care and other things like that. First, in wage replacement or income replacement benefits in Saskatchewan, we cover up to a gross annual income of $103,000 all the way until the injured person is age 65. I'm going to contrast that where it's the worst in Alberta and Ontario, which covers only $30,000 or $40,000 of lost income for a maximum of 2 years, with some exceptions. After that, you're on your own. Medical and care benefit costs in those same provinces are $50,000 or $1 million, whereas in Saskatchewan here we have $7.3 million, and no injured person has yet to hit that level at this time. Another major reason why there may be differences between the rates in Saskatchewan and other provinces is called seasonally adjusted rates, or seasonality. This is a practice in other provinces where the rate charged for a vehicle depends on the month in which it's registered. The best way to explain this is if you take out motorcycle insurance for a year in Alberta at the start of the motorcycle season and try to cancel at the end of the season, you will get almost nothing back because the premium is intended to cover the riding season. That's the months it was supposed to be charged for. In Saskatchewan, we don't have this practice. And as a result, we can see that the riders here will tend to register their vehicles for not the full year. It just makes sense. Most riders will register their vehicle for between 4 and 7 months, with an average about 5 months in the year. When we adjust for this, we can see that the annual amount paid by the average motorcyclist in Saskatchewan is around $600 after a safe driver recognition discounts. That's the comparable number. Using this and comparing with other provinces, there are some comparisons that can be made. I apologize for the small numbers on this screen, but Manitoba, MPI, did a comparison of a variety of different driver profiles and motorcycles and compared those rates across Canada. Adjusting for seasonality, we can see that SGI's number, the green on the left, is lowest or among the lowest in each one of these examples that were selected by MPI for this profile. This is a 35-year-old male, claims and conviction-free. Another profile selected by them, a 50-year-old male with one at-fault claim, has SGI as the lowest rate for all except one, and which is the second lowest. Another comparison done in BC by the insurance company of British Columbia. They hired Ernst & Young to perform the analysis. It was a rate comparison for more general vehicles, but they included one motorcycle profile in there. They performed the adjustment for seasonality there, and again, SGI comes in the lowest. So why is SGI coming in lower on all these comparisons? It's because we're the only ones still not charging motorcycles enough compared to their claims and expenses. Moving on from there, onto permits. Permits are another group in the auto fund that hasn't had a rate indication in a very long time. So a new actuarial rate indication has been charged for permits whose rates hadn't been changed for over 20 years. We have some increases planned for the premium here. They tend to be for about 8-day or 24-hour terms, very short-term amounts. and we are proposing to adjust their premium to align it with the claims risk. For 24-hour permits, we can move from $20 to $26, and 8-day permits from $48 to $73. Taxis are another group that require an increase. The indication shows 38% increase required for this group. With capping, that increase is proposed to be only 13%. Rate increase need is no new story for taxis. They have required between 30 and 40% in each of the rate indications from 2012 to 2014, and that's continued now since they were never able to get there as a result of the capping process that we put in place. Back in 2013, we performed a review of the business recognition program, and in this we worked with a lot of taxi companies and other stakeholders to address any potential issues they had with the program. And from that, a number of changes were made. The maximum discount increased from 10 to 15%, the maximum surcharge was reduced down to 25%, and we adjusted the rules so that the program applied equally between individuals and companies in the program, which was a specific request of a number of taxi stakeholders in that process. A new group in the auto fund are transportation network companies. So these are unique in nature and required a different rating structure to be able to correctly price their vehicles. The rate is charged as a per kilometer rate that's driven while ride sharing. And this is because usage differs between different vehicles within the group. One rideshare vehicle may operate every day and have a risk profile very similar to that of a taxi, whereas another may only operate one evening a week and have a much reduced risk profile. The rate was initially set up as 11 cents a kilometer, and it's not planned or proposed to change with this rate program. It occurs only while ride sharing. To come up with this 11 cents a kilometer rate, we used the adequate level of taxi rates, not the current ones. I want to reiterate this point. If we'd used the current taxi rates, not the correct adequate ones that are expected to break even, we would have only charged transportation network companies 8 cents per kilometer. Another group with a significant rate need is motorhomes. Their indication comes up with a 135% rate increase required. And this is significant. After capping, it's only 20%. But this is a rate need that has been growing since 2014. What we're seeing here is strong growth in rodent infestation claims and the costs required to clean those up. There's a lot of concern about the viruses carried by these rodents, and as a result, that's driving the costs. The last vehicle group I'm speaking to is light vehicles. I haven't spoken to our largest group at this time, private passenger vehicles making up the biggest component here. But what we do to rate this group is to combine the experience we've seen for them in Saskatchewan with the experience seen across Canada by other insurers. The Insurance Bureau of Canada aggregates this information from all insurers in Canada, because we may not have enough in Saskatchewan for a very specific make, model year vehicle. For this group, we have an overall 1% decrease proposed, and it does vary by vehicle. That's the key thing I'd like to point out here. I got some examples on the screen. The 2010 Dodge Grand Caravan, the 2007 Toyota Camry, and the 2008 Honda Civic are all slated to decrease, in some cases by significant amounts. The 2018 Ford F-150 and Chevrolet Silverado, on the other hand, are increasing. Other vehicles may have a smaller increase or decrease or none at all. So we have a PDF on our website that shows the list of all the different makes, models, and model years, so you can look up your own there as well. Finally, I want to finish talking about one thing that Jeff mentioned, one of the operating philosophies, which is keeping rates as low as possible. With this rate program, we propose an overall net revenue neutral, 0% change. In this, the history of rate changes for the auto fund in the aggregate as compared to CPI, a measure of inflation. Since 1999, CPI has risen by over 50%, but the cumulative rate changes in Saskatchewan as a whole have totaled only 7%. So it's one of the ways that we're trying to keep rates as affordable as possible for Saskatchewan residents. So hope you found this useful in understanding the rate changes SGI is proposing and the experience we've seen for various classes of vehicles.
Thank you, Jeff and Chris, for that presentation. A lot of information there, and we'll take questions at the end of the evening. Right now, I'd like to call on Elena Young to come forward and make her presentation if she's here. Yeah, there she is.
Thank you so much. Good evening, everyone. My name is Alina Young. I'm the NDP MLA for Regina University, and I am the critic for the official opposition for SGI, which is the capacity that I am joining you here tonight in. And I'm here to offer some comment on the submission that SGI has made to the rate review panel. I'm not going to speak to a number of specifics. I do note there are a lot of people here tonight who will likely be able to do that much better than I. Thinking in particular of motorcycles. I'm not going to BS you guys that I know a whole lot about this, although I do want to note for the panel that despite never having ridden a motorcycle in my life, I have heard extensively from people in the community across Saskatchewan who do have concerns about the proposed rate increases. So I do just want to note that for the panel, we have had a significant number of emails and calls through my office as well as in-person meetings, specifically with motorcyclists and folks concerned about personal trailers as well. So at a high level, SGI is essentially asking in its package for a revenue neutral change to premiums, as was gone over, 1.7% increase in rebalancing for different type of vehicles, offset by this 1.6% decrease in the capital margin for all vehicles. And in sum, what I'm here to say tonight is that with all respect, SGI should have submitted a plan for a rate reduction given the significant amount of funds it is sitting on in the rate stabilization reserve and the growth of that reserve in recent years, which we just saw in the last presentation. So as was canvassed, SGI does have a target for how much money it needs to keep in reserve to prevent these larger rate shocks in the case of major claims event. And as was indicated, that target is called the MCT, or the minimum capital test. And SGI's minimum capital test is 140%. And I would note here, I believe my understanding is that it is SGI that sets its own MCT. This isn't anything that's done through regulations or legislation, but this is fully within the control of SGI to set this MCT, which is currently at 140%. I would also note for the room, I'm not at all suggesting this, but Manitoba Public Insurance, I believe their MCT is at 100%. Personally, I tend to be a little bit conservative in how I approach things, so I can appreciate that we may want to have more money in reserve. But currently, the 2020-2021 SGI annual report shows that even after rebating that $285 million back to policyholders, the fund is still far above its target and is sitting at 168%, a full 28% higher than that 140%. So the bottom line here is that SGI has too much money in its reserve because too much has been charged to Saskatchewan people for insurance. And so I believe I'm here today Thanks. I believe it is time to lower rates and to make life more affordable for people. We did see the chart in regards to CPI, and this does impact all of us, and I appreciate that it does impact SGI significantly as well. However, that same increase impacts all of the people in Saskatchewan, and we are seeing those same cost increases in our own lives. I believe that it's time to do what we can as a province to make life more affordable for people and to ensure that the SGI Auto Fund is working in the way that it is supposed to on a break-even basis that works for the people of this province. And now this is the only part where I'll be a little bit spicy. I can understand the government may not want to do this. As you are aware, our government is currently running the largest deficit in the history of the province in the 2020-2021 fiscal year, largest deficit in the history of the province. And under summary financial reporting, which is the system that the provincial government adopted in 2014, all Crown Corporation revenues are treated as income on the province's books. So while the government of Saskatchewan may not be able to take money out or put money in to the auto fund, any reduction in Crown Corporation revenues, such as auto insurance premiums, they show up on the province's books as a decrease in income and consequently leads to a larger deficit. So I don't doubt that the question of a larger deficit is weighing large on the minds of the provincial government. However, at the end of the day, SGI is bound by legislation to operate on a break-even basis and to keep rates affordable for people of Saskatchewan. Although insurance rates in our province are lower than other jurisdictions, that should be of no concern to SGI or to the panel when considering what change in rates to recommend to the government. There is simply no reason to cut rates when the rate stabilization reserve, there's no reason not to cut rates when the rate stabilization reserve is sitting at 168% and the target is 140%. So in closing, I would respectfully urge the panel to reject SGI's submission for a revenue-neutral rebalancing of rates, and I implore you to recommend to Cabinet that SGI cut rates for Saskatchewan people, given the hundreds and millions of dollars in excess revenues that have flowed and continue to flow into the rate stabilization reserve. Thanks.
Thank you, Elena, for those comments. We appreciate the information that you have provided. I would also ask that you send us a copy of your remarks so that we can put them onto our website so everyone would have access to them. I should also have said before we started is that this meeting is being recorded as well as being broadcast through Facebook, and a full copy of that recording will be posted on our website, so you could go back and look at any part of it at some point in time. I would now like to call on the taxi group to present. Glenn Solly from Capital Cabs, I believe, is here. So Glenn, if you want to come up to the podium, please.
Good evening. My name's Glenn Solly from Capital Cabs in Regina. This year, the taxi industry was thinking that we would get a decrease in our insurance. Instead, we are getting a hefty increase. SGI evaluations previous year brought a lot of changes in our industry, and it needs to be accounted for. Rideshare came to Saskatchewan, taking hundreds of thousands of trips away from the taxi industry, plus hundreds of thousands of these rides. Operators take hundreds of thousands of trips not booked through the rideshare companies. Also, Facebook is the same way, hundreds of thousands of trips, road drivers taking trips away from the taxi industry. This all comes off the taxi driver's income, plus in the taxi industry lost hundreds of our drivers. What has happened with the PB class also has affected the taxis, the limo industry, forcing me to get out of the limo business. As you are aware, COVID came and destroyed the transportation industry. It will take some time for the taxi industry to come back, but it will never be the same. We must understand that through these difficult times, the only thing that was working was the taxi industry. There was no limos, there was no shuttles, there was no bus services, there was no rideshare. Just the taxis were working and putting their drivers' safety at risk. This was a very scary time for all my drivers, and I'm very proud of every taxi driver in Saskatchewan that worked through these difficult times. The taxi industry was the only transportation for the public. We need to protect the industry, not find ways to hurt the industry. SGI plays a major role in this. They can help us survive or destroy us. From insurance costs and to putting regulations, or should I say, deregulating the tax industry. But when you do this, what is left? The tax industry is a very tough industry. The taxi industry is very tough times, but deregulating and putting our insurance up is not good. When we have meetings with SGI, all we get is reasons why our rate should increase, but our income has dropped. And this means less taxis spent on the road. Right now, our taxis are down 50% of the time, but the public needs our industry to do well. They need our service. Not everyone has a visa. Not everyone has a smartphone. We need the industry seems to specialize in taking seniors and children, which rely on the tax industry, to be there for them. But we need more than that to survive. I went into the taxi accidents not at fault. It's 66% of the accidents not at fault. The best of all the classes. But we're paying the most. And you're increasing it. But if you want to look, maybe SGI should change everything and charge the 16-year-olds, the 26-year-olds, their rate, the different rates, since what I was told that their rate would be too high and they wouldn't be able to afford it. I think SGI should put everything together and make it easier on everyone. The ones that get into accidents would pay more. I do know the tax industry plays a major role in the public transportation. We need to support from SGI or higher up. I see how the industry is moving. Everything, taxi apps, getting away from dispatchers, cutting costs. Capital Cab's customers have a choice right now. Their apps or live dispatchers. Most people want to talk to live dispatchers. So the facts are the taxi industry lost hundreds of thousands of customers. Trip counts are down. Taxis not putting on as many kilometers on their vehicles. Lost hundreds of thousands of that trips. And there are thousands of other part-time operators with rideshare, Facebook, etc. So our rates should have dropped, not gone up. This report that SGI did was done before rideshare and declassification of the PBs, which played a major role in the effects of the tax industry. This should have reduced our rates, and we are paying 3 times the rates of other classes doing the same work and now getting 40% less revenue. As you are aware, COVID-19 caused a major blow to the industry. SGI didn't take into account how the changes would affect the destruction of our industry. SGI did a report on the PT, that's the taxis, and didn't include rideshare and declassification of the transportation industry, including the buses. In the report to you, not enough current data, they said. They should have estimated and took into consideration the damage they did to the regulating the industry, such as the tax industry, and should have compensated our industry for these major changes. They knew this would hurt our industry big time. Our drivers are full-time and make a living from this, and they don't have any other income. Rideshare does so-called, they call it part-time, taking premier business away from us. Instead, they want to increase our rates, purposely reducing our customer base. They knew the taxi industry would suffer from this, but turned a blind eye on this, which hurt hard-working drivers trying to make a living. Rideshare gets part-time insurance rate, but we pay 3 times more than the rideshare, regardless if the car works or not. For example, if I have a car that I put 500 kilometers on a year, and should I get a discount on my rate when the next guy puts 20,000 kilometers on a year and pays the same rate? Maybe SGI should consider this also. And let's be fair, that's what's happened with rideshare. Less kilometers, cheaper price. And they should have paid the same rate as the taxi industry. Also, no set customer fee. The sky is the limit for rideshare. That's how rideshare companies make billions of dollars. Less regulations, cheaper insurance. The industry needs your help. And please leave our rates the same or reduce them. Thank you very much.
Thank you very much, Glenn, for your comments. We appreciate you being here tonight to represent your industry. I believe Sandy Archibald was also going to be here to make a presentation. Sandy, are you here? Oh, okay. Do you want to come to the front?
Should've brought some water up. Hopefully that'll be okay. Yeah. That's lost, that's lost. Not gonna be here all night. Thank you very much. Thank you for the opportunity to speak to the panel tonight. My name is Sandy Archibald with Regina Cabs, and I'm addressing the proposed rate increase of 13% to the PT class of urban taxis in Regina and Saskatoon. The proposed increase is $582 annually per taxi, and in Regina that would amount to $81,000 per year, removed from the taxi operator's revenue. The PT taxi class is very small. SGI data shows that the 2020 annual registrations at 517 vehicles, which includes small and large cities, Prince Albert, Regina, and Saskatoon combined. We note that part of the panel's mandate is to provide government with an opinion regarding the fairness and reasonableness of the proposed rate request. We make 3 requests based on both fairness and reasonableness. First, stop any premium increase to the PT class. The timing of an increase is terrible. Second, recommend to SGI to seek ways to increase the class or the pool size by including the ride-sharing vehicles with the PT class. And lastly, for SGI to consult with the taxi industry to investigate a more flexible premium rate and the feasibility of charging a ride-share, similar to the ride-share per kilometer premium to the taxi industry, and the pros and cons of that regulatory scheme. Vehicle operation has changed significantly since ride-share and since the pandemic. Legislation allowing rideshare in Saskatchewan took effect in December of 2018, and to date is primarily Uber, both in Regina and Saskatoon. In February of 2019, Uber took to the streets in Saskatoon and followed in May of 2019 with Uber here in Regina. The economy in Regina was already very sluggish in 2018 and 2019, and ride-sharing had an immediate negative impact to the taxi industry in Regina. A City of Regina report dated February 2021, and they call it for hire transportation, trip data showed that by December of 2019, 7 months after Uber launched, the taxi industry had lost 28% market share to Uber. In the first 3 months of 2020, that trend continued until the pandemic was declared in March of 2020. The same city report states that in January of 2020, there were 635 ride-sharing drivers in Regina. It should be noted that each driver is equal to a vehicle, and the Regina taxi industry was outnumbered by approximately 4 to 1, as there's no limit on ride-sharing vehicles within the municipality. As well, we estimate approximately 30% of the revenue earned by rideshare is going out of the province to high-tech, multi-billion-dollar California-based corporations with no footprint in Regina or Saskatoon versus small local family businesses, because each taxi operator is its own small business. Then the pandemic hit in March of 2020, and the taxi business almost literally fell off a cliff. The demand for taxi service decreased dramatically. Schools were closed, people were working from home, airport passenger traffic declined, hotels were empty, restaurants were closed. Casino capacity was decreased and eventually closed. Community health programs stopped. Public events such as concerts, trade shows, football games, hockey games, all stopped. The majority of taxi operators stopped operating due to uncertainty. Many operators and drivers live in multi-generational households and were concerned for their health and the safety of their families. As Glenn mentioned, we do want to recognize that a few operators and drivers continued to work in the early months of the pandemic to transport the few customers who still had to go to and from work, particularly in the healthcare field, to get their groceries or medical emergency appointments. Those frontline drivers did great work during very uncertain times. However, there was no reduction in the SGI premiums despite significantly reduced utilization. As I said, the vehicle utilization continues to be dramatically reduced from pre-pandemic use. In summary, the Regina taxi industry suffered with 3 hits: a sluggish economy, the advent of rideshare, and the pandemic. However, we don't want to be out. We want to continue to provide service. What we need is relief, not an increase. The industry is just now starting to get back onto a bit more stable ground with the reopening of the economy, and it cannot absorb a 13% rate increase. There are still some taxi vehicles out of service, and many are being operated with only 1 driver. There's a shortage of drivers, as some drivers are still concerned about their health, some have left the industry, some have moved away, and some may even still be collecting the federal CERB payments. From an accident claims perspective, it should be considered that the risk is low, as SGI data shows that the taxi class has the lowest at-fault claims out of the 7 classes they compared, and we are only at 37% at fault. Private passenger vehicle class is at 44%. During the 2018 consultations with the government prior to ride-sharing legislation, the industry was led to believe there would be a level playing field regarding driver requirements and SGI premiums, but that was not included in the legislation. Now is the time to revisit taxi and rideshare premiums. Taxi vehicle utilization has decreased as described. Less utilization equals fewer kilometers traveled, and it should follow that there are fewer accidents. We don't have the flexibility with a taxi to register it for a few days a month and not others due to the steps required in the municipalities. So how do we level the playing field? Should the premium for taxis be calculated and charged based on the number of kilometers traveled while drivers are engaged with the customer, similar to rideshare? We need to have those discussions. We hear the words higher exposures, and taxis do have a higher exposure because a taxi is on the road a greater number of hours compared to the general public and in all types of weather. However, it must be considered that the average member of the public depends on the taxi being there when their vehicle won't start or the weather's inclement and they don't want to drive. As well, taxis provide an affordable service to people who don't own vehicles, the senior who's decided the time has come to stop driving, the non-ambulatory person who may be unable to drive, and the impaired person whose society doesn't want to drive. Taxis supply a necessary, vital, and affordable service to the public. As Glenn stated, not everyone can use a rideshare. Not everyone has a smartphone. Not everyone is banked with a credit card. The vast majority of our customers don't have those facilities. It's difficult to quantify the effect of an accident that didn't happen because an impaired person chose to take a taxi or a person with a slower reaction time chose to call a cab. However, it's vital for SGI and the panel to factor this into the overall premium rate that's applied to the PT taxi class to ensure the continued viability of this vital service that does not receive any public funding. We request that the panel recommend no rate increase to the PT taxi class. The real solution is for the industry and SGI to review the rideshare and taxi premiums after more data is gathered regarding rideshare and the vehicles and claims, and how to group those vehicles into the same class or pool. The vehicles and drivers are engaged in the same activity of transporting the public for remuneration. Many taxi operators use their taxi vehicle for private use, similar to rideshare vehicles. As we heard by Chris, in prior years, consultation between the industry and SGI yielded positive results for the business recognition program, and we would look forward to the opportunity to work with SGI personnel to explore flexible premium options, which may include a per kilometer premium. The taxi business has changed dramatically, and it's unclear when it will return to some degree of normalcy. But thank you very much for the opportunity to speak to this application.
Thank you, Sandy, for that presentation. and we certainly appreciate you being here this evening to express your views, and we will be listening to those. I would appreciate if both you and Glenn were able to provide us with a copy of your remarks. It would help us. We'd put those onto our panel website. And although you will be, as I said, you are recorded, and it will be available for people to call up onto our website and have a look at. So, at this point, before we get to the motorcycle groups, I just wondered if there are any questions at this time related to taxi rates or anything related to taxis, since Glenn and Sandy have just spoken. Can you please go to the mic so we can hear you? Please introduce yourself and who you represent, please.
Okay, my name is Nirmal Singh Maur. I'm Co-op Taxi. So our question is like so many taxi in Regina. SGI doesn't look anything. Like so many people taxi picking up in front of a strip and nobody look it. Like ride share, we have a class 4, they have a class 5. Our standards should be equal. And that's the way I can say. Thank you very much.
Would anybody like to respond to that?
Is this one? Thanks for your feedback. So as Sandy said, we have worked together in the past, and we know taxis provide an important service for us and for the public. So we're definitely open to talking about how we could get to a per kilometer rate. It does require the technology. That's the key thing. So as the vehicle is traveling and when it picks up passengers, that's kind of how it works with rideshare. And I know when rideshare first came in, we had many consultations with the taxi industry, and actually we're thinking that they were moving in that direction with some technology. So very open to meeting with the taxi industry and talking that through and seeing how we can help in that regard.
Yes.
It's pretty hard for you to do that because of all the rogue drivers. Unless you can guarantee there won't be any rogue drivers, I don't know how that's possible. There's just way too many rogue drivers operating that aren't through rideshare companies. They're doing it on their own. Facebook, look at Facebook. Unless you can regulate and try and regulate all these road drivers, including the thousands of rideshare operators that take thousands of trips that aren't listed, they're doing it underneath the table. If you mean when I say underneath the table, they save their premiums that they have to pay, that 11 cents a kilometer, they don't have to pay it to you because they took a trip. It's frustrating for me to hear drivers come to me and tell me, hey, I made $200 through the rideshare company and I made $300 in my pocket. It's frustrating. And I don't know, I mean, there's ideas, a way to solve this, but that has to be fixed. And it's just like you open the borders on this. It's just wide open. Everybody does what they want. And this is what's happening. Everybody shuts their eyes, let it go, let it go. And what the drivers are telling me is, hey, I'm not worried about reporting this. I'm not worried about that. Because why? I don't get into accidents. And what you guys told me, would you insure, I asked SGI, would you insure a person that got injured if he wasn't through a booked through a rideshare company, and you still would insure that customer for an injury? I don't know how you're going to stop that. That has to be stopped. The thousands, the hundreds of thousands of trips have been underneath the table, but I think you guys think I'm lying. I mean, I'm not lying about it, but that has to be stopped. And we opened up the door. When they started this rideshare, you just flooded the market with every Tom, Dick, and Harry is doing it. They don't have to be listed with any company. They're doing it. No inspections, no criminal record checks. Go on Facebook. You need a ride? Just go on Facebook, get a ride anywhere. So that, I think that issue has to be solved too, and we have to look at that. Thank you.
I know with rideshare, the safety requirements are supposed to be consistent, and we do audits, and they do report. But like I said, we're willing to listen, to sit down with you, and talk about some of your concerns.
Okay, thank you. Yes, please go to the microphone. Introduce yourself.
Muhammad Rahimi from Co-op Taxi. Since we started just simple things, everything has changed. We used to pay $20 for criminal record check. Right now it's $45. Since that, and everything, city, we used to pay $125, 125 something. Right now we are paying $375. Everything repairing. The requirement, I bought for 20 years I'm driving. I bought the car from the auction, put in taxi. Right now, based on city regulation, it should be certain age, and they added computer, they added camera, everything. Level things that ride sharing should do that. They never impose those restrictions on them. Just taxi. And our rate is never $4 since 5-6 years, $4. And it hasn't increased, and there's no way for now. We're not asking, because our rate should be competitive. We are not asking to increase the rate. It should be like this. I'm not sure how long will it take. And everything has changed, nothing beside that pandemic, beside that this ride sharing, which is, I'm driving night shift. They are not supposed to stand and sit in front of the hotel. They are not supposed to sit in front of the bar. They are not supposed to be there, but they are sitting. There is no way to complain and stop them doing that and doing their job properly. They are, I know that it's written that they are not supposed to stand in front of the bar. They bring the people and come sitting in the bar. That's not my job to ask them to, you are not allowed to sit in the front of the bar and wait for the customer. You should wait somewhere, customer book your Uber and you come. But there no way, they might fight with me. That's not my job. We went to the city said, take a movie, take a picture, blah, blah, those kind of things. That's not my job. Police, we complain on police. Police also didn't listen to us. They are taking directly our trip, our income, and because of that, if things like this going on, we might not be able to find the driver. And right now, majority of the taxi owners, they just drive daytime, and they are not able to find a night driver. Because night driver, they're not making income. Their income is taken away from them. And everything has gone up 100%, but our income is beside not increasing. But right now, HGI also want the same thing the city did, the same thing everything did. They want to increase. We were expecting decrease. Even in Edmonton, they tried to $375. They want to apply to get rid of that money. And we were expecting to HGI give us a break instead of increasing. We are paying 3-4 times more than regular cars and getting the same kind of benefit. Nothing extra, just the same thing. We are paying 500, something like that. They are paying, for example, 100, less than 100, less than more. The same kind of things they are getting. Nothing more. And every day, their data shows that our most of fault accident is way lower than regular drivers. But we were expecting a little bit break to help this business running. But by these things, we shouldn't do that. At least if they are not reducing, keep it the same. Thank you.
Thank you for your comment. It sounds like there's many other issues other than insurance rates that you are dealing with, and I sympathize with what you're going through, and particularly in light of the pandemic, that I'm sure took your business away just about entirely. Is there any more questions regarding taxis? If not, I will call on Don Fuller from Rage to come forward and make their presentation to the group.
Well, I appreciate you guys hanging in here. This is great. What you're going to see from me is something a little different. You've heard SGI speak. You've heard the actuaries talk. It's actuary speak. It's interesting. It's a tool. Actuary analysis is a valuable tool, but it's not the only tool. But when it's the only tool in your box, like a hammer, everything looks like a nail. What you're going to see is something here that's much broader than that. The impact in our industry, the impact on people, and rates. What you're going to see is SGI's failure to recognize unique internal and external critical elements that affect SGI, the auto fund, its policies, and fiscal solvency. So we'll start back with, way back, with 09 to 14 rate increases and the effects it's had on rates and customer behavior and the repetitive leaning on the rate wheel over and over again as a solution to problems that are much broader than that. And the premiums are still not covering costs. You'd think you'd learn after a while that just cranking up the rate wheel doesn't seem to do it. But remember, if your only tool in your box is the hammer, what you're going to see is a very incomplete and inclusive data set. There's socioeconomic issues that come back all the way from 2004 to 14. You're going to see that SGI doesn't recognize the competition they have. Now, not in utility, not in the licensing, but it's competition that they face with their customers. And you're going to see the effect on the Saskatchewan power sports industry, which is enormous. So we'll start with the socioeconomic impact. It came with the oil boom, and it started in 2004. And I, for one, am not a big advocate of the boom. It was nothing but a pain in the butt here. It didn't do anything good for us. And what we ended up with was a transient workforce that came into Saskatchewan with highly disposable income. It was a young demographic, you know, the guys in their 20s, 30s, they're the guys who are working on the rigs. And they were making between $100,000 and $200,000 a year, disposable income. And that was turned Saskatchewan into the Wild West. There was lots of money, lots of free time, lots of money for four-wheel drives, lots of money for skidoos, motorcycles, the works. It was the Wild West for quite a few years. And that effect was actually felt across all demographics in the province. 08 were just the highest in the country, deaths, injuries, all because of the boom. They were here, they had lots of money, lots of time, and it was just wild. In fact, it was so bad that they established a legislative traffic safety committee to try and deal with it. But the funny thing is, the only people that are being really penalized for this is motorcycles, because they've taken motorcycles, which is a very, very, very tiny amount of the auto fund, 1.7%. That's nothing. And they said, you guys stand alone. Now, there's no regulatory requirement, there's no legal requirement, it's an arbitrary decision to say you guys all have to stand on your own. You can't be cross-subsidized by the rest of the population. But within the motorcycle demographic, drivers with clean records who have never had an accident. You've got lots of other vehicles, and you're still being penalized, and there's crop subsidy, but it's just within the motorcycle demographic. And that's a choice that they've made. There's no requirement anywhere for that. And we've been taken out of the larger pool, the risk pool, that makes us look bad by the numbers. Now, the other competitor that they don't recognize they have, and they do have one, it's called the wallet. And this is an important piece to note. It comes in early in the presentation. There's two kinds of spending. Everybody has them. There's utility spending. These are the essentials. That's your house, transportation, groceries, clothing, taxes, those things that you got to pay every month, come hell or high water, right? You got to do that. And then there's discretionary, which is non-essentials. That's your boats, your motorcycles, tobacco, restaurants, movies, luxury items, vacation stuff. Those things can all go by the way when the utility costs are too high. You don't have to do that. And what's happened now, the rates have escalated to such a point, we have the highest rates in Canada, contrary to what the slide shows, and we have the highest rates in North America, right here in Saskatchewan. And if you don't think that affects your discretionary spending and utility spending, you're wrong. Now, the Sask power sports industry is another one that's being decimated by this. And we've gone to the dealerships, we've talked to them, and they've given us their numbers. And we went both rural and urban to make sure we get a good picture. And we also included the Motorcycle and Moped Industry Council, which is a sort of a national group that advises these guys on marketing issues. And there's about 40 different dealerships for different products across the province. So what's happened? Urban power sports industry, model sales decreased $1 million. That's a big number. Service revenues increased 40%. Merchandising, 50%, $500,000. Parts sales decreased 40%, again, $500,000. And this is in a province where the economy is staggering now. In the rurals, it's not any better. Model sales have decreased by 50%. You can't find a sport bike on the floor in a dealership in this province because the rates are so high that they don't even order them anymore. So that industry is suffering greatly, all because of excessive rates. Their service revenue are down 30%, merchandising 20%, and the losses are similar between urban and rural. They're both in a real pickle, and they're both around the $2 million mark. And here's a quote. Total estimated economic impact of the 40 Saskatchewan motorcycle businesses between 2013 and 2020 are directly related to back-to-back SGI increases through 2012 and 14. And the combined total, when you take that across 40 different dealerships for products, is $80 million lost. That's jobs lost, that's positions lost, revenue lost, and tax lost, because the rates are so excessive, they're killing an entire industry in the province when we need them all the most. So we'll go back to 2013. Initially, SGI came out with a proposal. I got news of it in 2013, one day in February, that SGI was coming forward with a rate proposal of 73 to 300% increase. Within 5 to 10 days, we had started up the RAGE organization. We had 5,500 people, wild. If you had an increase in your power bill, in your gas bill, at the gas pumps, there was between 73 and 300%. The pushback in this province would have toppled the government. It was just unheard of. Brad Wall actually came out and did the right thing and publicly apologized in all the media. And he told SGI, no, stop. You got to pull back the proposal. And he established the Motorcycle Rate Review Committee. So SGI came back with a rate proposal of 34%, not 73 or 300, and that was the beginning of the Motorcycle Review Committee. Now, there was lots of things we learned. That were actually negligence on SGI's part. At that time, to have a motorcycle learner's license, you didn't even have to have a Class 5 driver's license. You could sit down at a silly computer quiz for 5 minutes, and SGI would grant you a learner's license, never having driven a vehicle, a car, a truck on a city street, anything. And you could go out and buy a 200-mile-an-hour Hayabusa and drive it in the city, on the highways, and you could do it forever. There was no limit on how long you could have a learner's license. You never had to be tested. This is their responsibility, but we end up paying for it. The only clothing required, you could ride around with sunglasses, a helmet, and a bikini on. No shoes, no pants, no shirt, no anything. And they wonder why injuries and costs are going through the ceiling, and they're responsible for regulating this? No testing. At the same time, and there was a slide that came up about administering at fault. It said 2012. That's not true. I remember negotiating with Don Thompson, the vice president, in our meetings, and the at-fault was not that way. They backdated it, but it wasn't the way it was. He told me it doesn't matter anyways, because in Saskatchewan, the insurance you buy is the insurance you get. That's a quote. I said, what do you mean? He says, in a 2-vehicle accident, we don't care who's at fault, because all of the costs go to each of the 2 vehicles, regardless of fault. So that means motorcycle gets all the injury and the vehicle, no matter who runs down who. We fought and debated over that for a long time, and they relented, and now we have a policy like every other insurance company in the world that says at-fault drivers are accountable. At-fault drivers are responsible for the costs, not the victims. And we got that changed. So that was part of the rationale, those lopsided accountings for different rate proposals and increases that never should have been. It was lopsided accounting and bad policy. $9.2 million error. Rationale for the 2013 rate increase. But remember, if your only tool in your box is a hammer, everything's a nail. So you just lean on the rate wheel, and away we go again. Other things we found out, once we corrected this issue, SGI found that $300 a year in annual premiums was no longer required just by changing the at-fault and the loss policy. None of this wouldn't happen if we hadn't been in the Motorcycle Review Committee, if SGI hadn't been pushed to rectify these problems. By adopting a provision for loss transfer, and this is where the at-fault stuff comes in, if you're the person who causes the accident. Claims cost for the motorcycle class was reduced from 9.8 to 5.9 million. That's a fair chunk of change, a 40% reduction. For a portion of 2012, the number changed from 866,000 to 553, a 36% reduction. None of this would have come to the forefront without the Motorcycle Rate Review Committee. It just wasn't talked about. So here's your at fault. They had told us that we were at fault the majority of the time for the accidents, and I said, bull, that's not true. Even the grandfather of all reports for motorcycles, the Hurt Report, knows and states that motorcycles are run over by four-wheel vehicles more than 50% of the time. So when you did the reversal and got the policy right, there's your numbers. We're not at fault most of the time. Other vehicles were at fault 54% of the time. Again, the false narrative created and used as rationale for rate increases that never should have been. So we negotiated and changes were made and implemented. And there's always a lag time of a year or so to get them done because corporations are slow, notoriously slow. And we changed the licensing requirements. We brought in the 3-year learner program. SGI was very progressive. We tried to figure out how to make training mandatory, but there aren't enough training outfits in the province. Province is too big and it's too sparsely populated to make it work. So we came up with the first 3 years of a learner's license, you're very high risk. So they wanted to increase the license fee to $500 per year for 3 years. They said, but we can also incent new riders to take the course. They said, we'll pay for it. Fair enough, that's great. And if they take the course, the $500 for each of the 3 years for your license, even though you're high risk, because the risk is now mitigated because you've taken training, we'll wipe those out too. As long as your record's clean and you've been good. There's a few conditions on it. So they were allowing people to drive these things on a learner's license, never tested, no requirement, and it is their responsibility to have done that with improper clothing. So we had all of these things put in place. You got to have ankle boots, you got to have your arms covered with a jacket, you got to have at least pants on, zero alcohol, these kind of things, and the monetary incentive. And it worked. No rate wheel, no increase, just good common sense and doing things that looked at the demographic and said, what needs to be done here? We also said, look, and you saw slides again today about vehicles. This vehicle is high risk, that vehicle is high risk. Well, I've got vehicles at home in my garage, and they're not risky at all. They're really actually laying dormant on their side stands or on their four wheels. They're not at risk until somebody gets in them. And the cost should be, the onus should be on the high-risk drivers, not by some arbitrary class of vehicles. That's like rearranging the deck chairs on the Titanic. There's no answer to it. You're still going down. They need to address the high-risk drivers. There's no incentive for them to change their behavior. So we came up with a proposal. And they do have a program in place. It's called the Safe Drivers Recognition Program. And we crunched the numbers using SGI's numbers. And here's what comes up. If you increase the demerit points for driving infractions, depending on how severe they are, and the length of time that you have to pay those, that's high-risk behavior, you see the numbers starting to go up. Collisions, same thing. You cause an accident, and if you cause injuries, it's more. Criminal code infractions, it's more. In other provinces, you have a bad driving record, you have a really expensive or no driver's license. It's not just some arbitrary figure that they figured out you can just, because it's a Chevrolet, this is the risk. It's not. It's the person driving the Chevrolet, riding the motorcycle. If you added up the numbers off of that, Three-year the running revenue, for high risk, there's a number we came up with. These are SGI's numbers. We just crunch them differently from a different viewpoint. That's what happens when you make people accountable. You don't use the rest of the safe driving community to cross-subsidize high-risk behavior. And that's what they're doing. They said we can't have the bigger cohort subsidizing motorcycles, but within the motorcycle demographic, you can certainly have everybody else subsidizing high-risk drivers. Well, that's not right. You arbitrarily pick where you stop looking at the microscope? No, you don't. There's a social issue here, and it needs to be dealt with. Good public policy should shape public behavior, not cross-subsidize and decide who's going to cross-subsidize who. It reduces high-risk behavior. It targets the revenue for those who cause accidents, injury, and death. It eliminates chronic high-risk driving, enhances vehicular traffic safety, and reduces the human and vehicular costs. It's not that hard. This stuff isn't that tricky once you just back away from the rate table. Therefore, to mitigate the risk, it is the behavior of the operator that has to be the focus, not an arbitrary vehicle. And it doesn't matter if you want to pick on engine size or whether they're blue today or whether it's Tuesday, none of that works. And you'd think they'd have learned that lesson by now. All those things we put in place, and were put in place because we forced them through the Motorcycle Review Committee. SGI themselves stated in the review that the average cost for injury was $117,000. Today it's $90,000. That's almost a $30,000 reduction. Not a rate increase, it's a reduction and it's ongoing. And they also state that the reduction is most likely due to safety improvements. Not leaning on the rate wheel, not getting the highest rates in North America. So we pushed them and said, look, we put all these pieces in place. There's no use doing that if you don't stop and measure what we've done. Was it effective? Where was it effective? Where was it not effective? Because then you can tweak things, right? You can play with it. We weren't finished. We've been working with SGI since 2013, and it's never ended. So we pushed them for a review. 7 years, there was lots of time for the actuarial analysis. And they would get a good picture of what we've done, where we're going. And here you go. Collisions down 27%. Injuries down 27%. Average of 50% reduction over the decade. No rate increase, just good policy. Things that shape public behavior. We're in a surplus by 2015. They admit that it was the most successful program they've ever entered into. But they've raised rates. They've raised rates to the point where people can't afford them anymore. And here you see the numbers. They're dropping. The revenue stream is drying up because people can't afford it. It's discretionary spending. This is what suffers when somebody gets too greedy. The motorcycle class, and don't kid yourself, is headed towards insolvency. But Saskatchewan, we're a resilient bunch. We always seem to find a way out. And here's the way out. Permits. I'm not going to register. I'm going to buy a permit. 24 bucks for a day. It's 70 some bucks for 8 days. And we're not registering like we used to. We're registering by the weatherman. It's going to be a nice weekend. I'm getting a permit. I'm going out. I'm not going to pay 280 bucks for the month to ride. I'm going to pay 25 for the weekend because I don't know if it's going to rain. It's Saskatchewan, right? I don't know if it's going to rain or blow or what's going to happen next. So they're riding by the weatherman. We're a smart bunch. That's permits climbing. The line isn't quite straight up, but it's pretty damn close. Nobody's registering anymore long term. And here's the truth. 54% of the motorcycles were being registered for 12 months of the year. And they would let them lay in the garage, and that's fine over the 5, 6, 7, 8 months because it was fairly cheap insurance, and that was fine. But think of the revenue stream. It was large and it was constant because it just didn't matter. It wasn't imposing that much on your discretionary wallet. So people spent their money. It was fine. They were willing to do that. And SGI identified that if year-round motorcycle owners opted out for 5-month policies, the projected $17 million, which was the revenue stream that was projected at that time, revenues were reduced by 24%. $4 million, giving a projected new revenue stream of just over $13 million. And let's not forget that $9.2 million error that they were using for a rate analysis previously. So premiums decreased by 39%. There's another cause. And admittedly, they lost money in the market. The money that they had collected from us was no longer there. And we were being penalized to replace it. The motorcycle investments dropped by 42%. The market does that. But the market's never permanent. It's temporary. It goes up and down. But if you're putting in place permanent solutions to temporary problems, you've got a bigger issue yet. And that's what they do constantly. Lean on that rate wheel. It's a permanent solution to a very, very temporary problem. But the market's up. We got a $1.1 billion reserve now after the rebate. There's money everywhere. And here we are in another rate hearing. We know the rate review was successful. We know that safety was up. Hours of operation are better. The licensing is where it should be now. Accidents are down, injuries down, costs are down. And SGI admits, although the number of collisions has continued to rise again. Now that's a quote. And let's go back to that slide. Continued to rise again. If you see that yellow graph in the top black, you see those little upticks? Every graph does that. Every graph does that. It's like a saw blade. And that bottom line is material things. It's not injury. And it follows the total collisions. So those things are making collisions look like there's an uptick. But really, it's just a temporary. Nobody sat and waited it out. Instead, they jumped on the rate wheel. Here we are again. They themselves state there's no question the MC review was a success, a screaming success. If so, what happened? What changed? And why are we here again? And why is the Motorcycle Auto Fund facing insolvency? Why is it in the red? Let's have a quick look back again. The oil boom ended in 2014. the rate review happened, the inception of the Motorcycle Review Committee. They implemented all of our recommendations. We ended up with a surplus. You see where the bar is? Red, 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 but the numbers are decreasing. Where the bar is, those numbers are positive. We are ahead of the game. We were winning. Not from having rate increases, but from doing good policy that made sense. Accidents are down by 30%, but now you're starting to see the effect of the excessive rate hikes. Customer behavior is being felt by SGI. Customers have chosen a low-cost alternative. You're a resourceful bunch. Why pay more when I can get the same thing for paying a fraction of that? And the auto fund moves further towards insolvency. The solution is clear. The 2012 premiums at $13 million projected, and those aren't even the $7 million before that, before they started dicking with this stuff. We're encouraged and continued again. You would open your wallets and you would start to license like we did before, which provided in 54% of the cases a 12-month revenue stream. Huge money. And motorcycle registrations have not changed much. On average, they've been pretty static. They go up and down a few thousand. They're still sitting in the mid-20s for registrations. We're not having less motorcycles. We're just riding them according to the weatherman. So then the answer is an immediate return. The rate panel has to say, come on, it's simple. This is not tricky stuff. It's very, very simple. A return to the reasonable rates, create a long-term positive revenue stream, stay focused on the things that worked and worked well. To their own words, the best response they've ever had to a program. There's no need to change the motorcycle classes. Again, that's deck chairs on the Titanic. That does nothing. It's behavior. It's operators of 2 4-wheeled vehicles, 18-wheeled vehicles. It's not the vehicle itself. That's an arbitrary decision. However, if they continue to lean on the rate wheel, keeping us in the highest rates in the country, in North America, that's a fast track to insolvency. It'll be increased migration to permits. The revenue stream is going to shrink farther, and they know this. They know it. We've discussed it with them on numerous occasions. But they persist. But remember, if your only tool in your box is a hammer, that's it for us.
Thank you, Don, for your presentation, coming out tonight and being part of this meeting. I would now like to call on the Motorcycle Coalition. I believe someone is here from the Motorcycle Coalition.
So my name is John Haston. I'm a member of the Bohemians Motorcycle Club and the Saskatchewan Motorcycle Coalition. Kevin Jones, our secretary, was supposed to be here tonight, but he had prior engagements, so I'm here to deliver his letter. So I don't have a bunch of numbers and stats, just feelings. So to the chair, this letter was prepared by our secretary, Kevin Jones, who could not make it today due to a prior engagement. The Saskatchewan Motorcycle Coalition, known as the SMC, is a registered not-for-profit organization formed in 2011 with a mandate to lobby government on issues that affect motorcycle clubs, organizations, and their affiliate members. The SMC consists of over 300 members belonging to 20 motorcycle clubs and organizations in the province. Many of our members make a living in the motorcycle industry. Most of our members use a motorcycle as a means of everyday transportation when it's safe to do so, in the same manner those who own cars. This means we are experienced riders, many who have never had a claim. Since the rate increases in 2013, we have seen our members go from insuring year-round to insuring seasonal and now to permits. Members who own multiple motorcycles are now only insuring one motorcycle and using permits for the rest of those motorcycles they own. This trend is negatively affecting SGI's bottom line. What we are hearing from our members is that safe and responsible motorcycle riders are being penalized through insurance rates because they choose to use a motorcycle for transportation. Our members feel that those with positive safe driver recognition points should not subsidize those who are inexperienced or careless in the operations of motorcycles. By statistics, we know that young or inexperienced riders or inattentive automobile drivers cause most claims involving motorcycles. This is where SGI should be looking to rebalance instead of raising rebates dependent on the years and engine's displacement. Some savings could be simple as adding a horsepower rating to the graduated driver's licensing program. As we all know, some 600cc motorcycles come off the dealer's floor with 117 horsepower or greater compared to an 1,868cc Harley-Davidson Cruiser at 82 horsepower. SGI has made some incredible profits from investments with surplus of premiums that we feel should also be used to lower insurance rates across the board, seeing the money originated from the pockets of the insurers. We have seen some impressive reductions in collisions and injury claims in the past few years, which in return has saved SGI millions of payouts, but we think we can do better with even more education, awareness campaigns, and safety initiatives. SGI must make insurance rates affordable to attract more people to using the alternative means of environmentally friendly transportation in the years to come. We ask that you deny SGI's application for a rate increase and recommend that the Motorcycle Review Committee get back to work to find an alternative way to reduce insurance rates rather than just simply raising them. And that's on behalf of our Secretary, Kevin Jones.
Thank you as well for coming out this evening and making your presentation on behalf of the Motorcycle Coalition. I'll now open up the floor to any questions that people might have, and I would ask you to go to the mics and you can address the questions.
John Hassan. The question I have is, Rage has presented these numbers and their statistics over and over again. Does the panel dispute the numbers that he brings forward?
I'm sorry, I'm not here to answer questions.
What does SGI?
But, we will be considering all of the material that's presented by any group or individual, and if the information provided is verifiable, yeah, we will accept it, of course. Go ahead, Don.
To answer your question, all the numbers in our presentation were SGI's numbers. They were given to us in a presentation by the SGI executive, and they were from the motorcycle review that was done after 7 years. All those graphs were theirs. There's no numbers to dispute. They belong to them.
I'll just mention that there's a lot of numbers included in Rage's presentation, and a good portion of them come from information we've used before. They weren't all used in the correct intended use. So taken, potentially misused. If a number is quoted for one thing, but then quoted by Rage as something else, the number could have come from us, but it's not what it was originally intended to be.
I'm actually going to clarify that. I know which number you mean. This is Rhonda Swinar with Rage. They're upset that we quoted 54% for annual rates, where people plate all year round, 54% of the time. That was out of the 2012 rate review. They identified that 54% of motorcyclists at that time bought annual rates or annual insurance. They plated for the whole year. All but 2% canceled at the end of the riding season. When they raised rates from what they were in 2011 to 2012, they identified that they would lose $4 million by doing that. Excuse me, I'm upset. They acknowledged that they would lose $4 million by doing that, and they did. They estimated the revenue would be around $13 million, and it was. Rates continued to climb, revenue keeps going down.
Well, that's one of the many numbers that I would have referred to there. The $4 million premium number is also incorrect and was quoted as part of a hypothetical question by the panel at that time. We did not see that level of premium decrease.
Anyone else with a question?
Elle, you wanted to say something?
With respect to the numbers on crash reductions, it is important to realize that most of the changes that we made or were made in 2014, and that followed significant changes to motorcycle safety rules here in Saskatchewan that we introduced in 2010, 2011, were applicable to new riders. I think one person made a comment that most of the crashes are associated with young and inexperienced riders, and that is untrue. Whilst we've seen a lot of improvements when it comes to crash reduction for younger drivers or inexperienced drivers, the majority of collisions are still being attributed to the so-called experienced riders. And one of the graphs that Don didn't show clearly indicates that from 2018, 19, and 20, whilst we've seen some reductions in the rates for new riders or young riders, there's been an uptick in the rates for experienced riders. And by the sheer fact that the majority of riders that we have in the province are experienced riders, when you calculate the claims attributed to the experienced riders, it far outweighs that of the inexperienced and young riders. So we have to be very careful, when we interpret these numbers. It's like Chris said, it might be one set of numbers, but viewing it in the wrong way will lead to totally wrong conclusions. The second point I'd like to make relates to, I think a question was asked the last time about motorcycle sales in the province, and we therefore looked into it. We couldn't find out whereby age and gender, the people buying new motorcycles in the province and whether it's changed. But we found some statistics from the motorcycle and moped industry of Canada. And the least I would say is they are inconsistent with some of the numbers that Don provided. We will provide them to the rate panel, those reports to the rate panel, so that they can be put up on the rate panel page for everybody to see. But the numbers that we saw shows number of sales dipped slightly since 2013 thereabouts, and it started to rebound in 2018, 19, and 20. These are not our numbers. These are numbers from the moped industry of Canada, and we'll put them up on we'll give them to the rate panel to put it up on the rate website.
Thank you. Any further questions?
It's a basic question. What kind of third-party intervention does for that fancy little graph you guys had up there? Sorry, I had an accident at work, caused some brain trauma, so my words might be a little jumbled. So just bear with me here. That fancy little graph you guys had up there, is that all done in-house at SGI, or is there any other sort of third-party, non-biased review in with that?
To clarify, you want the rate comparison ones? Is that what you're referring to?
Well, like your whole graph for everything we saw from SGI, is there any third party that helps you guys, or is that all done in-house at SGI?
So for many of the ones that do a claims analysis here in Saskatchewan for us determining the rate changes, the analysis is done in-house, and then as part of this review process, an actuary is hired by the rate review panel, a consultant who would review SGI's numbers and provide that level of audit. In terms of all the graphs that we showed, I will point out that the rate comparisons with other provinces were done externally by Manitoba's comparison, as well as BC's comparisons, just to provide that level of third-party independent comparison to show tonight.
All right, and one other thing before I leave, it's just more of a statement. What you guys are going on, everybody, all these fancy numbers and graphs and that, I can't quite follow all of it. Most of the time you guys move pretty fast. I'm a pretty slow hands-on person, but well, even with all this head trauma and that, my therapist, she recommends me to ride motorcycles because it's therapeutic, clearing, really helps me out. So before I got hurt, I was making pretty good money. A person could go in, plate their bike, ride, knowing they have full insurance. Hell, just today I had 5 cars cut me off, one person almost back into me on the motorcycle. What kind of fault coverage would I have there? These people are not looking, driving cars, putting my life at risk. On Facebook, I saw a person post, "It's motorcycle season, everybody let's be responsible for these guys' safety." No, it's open your eyes, watch for us. I'm sitting at a red light. The bike I ride is quite big. You should be able to spot me out. But now that I'm on WCB and all this other supplement stuff, I can't even permit my bike, and my therapist is telling me, go out, ride your bike, it's therapeutic. And you're talking about increasing permit rates. How can a person in such as my situation even justify riding their motorcycle when a doctor is telling them to go out and ride a motorcycle when you can't afford basic monthly plates, and now you're talking about increasing permits? That's just unreasonable, and well, in my book, I'm just mad about it. But before anything is actually done, I would really like to see you guys bring in a non-biased third party, not SGI, not Rage or anything, even though I really like these guys. Bring in a non-biased third party, give them all your numbers and books and let them lay out a graph and see what they come out with. I would very much like to see how that resulted. And if it came out in kind of the same way as you guys are coming out with, I'd be more accepting of the rate increase, but I would very much enjoy to see what a third party came out with. Thank you.
Well, speaking from the panel's point of view, third-party reviews are not always, but usually a very good thing. So I appreciate your comment. Anyone else?
Hello, I'm Randy Padfield. I'm with Southern Independent Riders from Congress, Saskatchewan. We are a nonprofit group. We've been around for a very long time. In 2019, we hosted the 40th annual St. Victor Boogie. We used that event to help fund the charities that we support. Over the course of our time, we've generated over $350,000 for these charities in a local area in southern Saskatchewan. The local people down there depend on us. Our club started with grassroots guys. We were all from the local area. We were coming out of school. We were getting onto bikes. This has perpetuated through time. Now, our youngest members are 35 years old. There's nobody coming out of schools getting on bikes anymore. It's just too expensive. Stuff like our organization, I'm sure as we go around the province, there's lots of nonprofit organizations in the same area as we are. There's nobody to fill in where we are. The charities in these small towns are going to affect. One other thing you said that gets me, you said that the accidents aren't happening by the young riders. We're seeing that because the young guys aren't buying bikes. They just can't. You know what I mean? The plates are too high. And I get we say that guys with bad records, but you take a young guy with a record, he starts at zero and he has to go to work toward his 20% discount. It's too much. I get when you're 60 years old and you have a 20% discount, but you got to perpetuate. You got to get these guys on bikes. Thank you.
Thank you for your comments. We appreciate that. Anyone else? Yeah, come forward.
Hello, I'm David Wally. I just wanted to make a quick point about how engine size is not the best or only metric to look at, and even horsepower is not terribly useful. As I'll show with a couple examples, I have a couple of bikes. I have a 200cc Enduro. It'll spin the back tire, it'll lift the front wheel, do catwalks, 0 to 60 in very few seconds. I also have a 1600cc Cruiser. It won't spin the tire, it won't lift the front tire, it won't do any of that stuff. It's like driving a big old Cadillac. As Don and others have said, the risk depends on the behavior of the driver, not the size of the engine, so stop pointing to the size of the engine for the justification on the hikes on big bikes.
Thank you for that comment. Yes, go ahead. Your mic, please.
Hi, my name is Amarjot Sahota. I've been in Canada for 11 years. I've been riding for 9.5 years. I have 2 bikes because of SGI raising the money every year. I have a 390 bike. It's a KTM Duke, which I have to ride in the city or convince myself that, oh, because I love riding, I have to ride a smaller bike because I can afford it. I have a 1200cc Harley. I've never been in an accident. I've never even thrown my bike once. Like, leave alone the accident. We are experienced riders. Give us some break. We are not here earning money out of motorcycles. It's something we love. It's our generation. There are guys younger than me that want to come, but it's too expensive. Just don't make expensive for us. There's a whole group. There's a younger generation coming who want to learn, who want to ride, who want to enjoy this life. It's not just, we are not here to just be in home, and if you make everything expensive, it's just hard for everybody. Thank you.
I'd also like to talk about the CC measurement. When you showed the one graph and you showed like all the smaller CCs have smaller accidents is because you can't go anywhere on those bikes. The reason some of those increases are so much higher, the bigger bikes when you're on the highway, of course your increase on your accidents are going to be more expensive because the accidents are more severe. So if you want to do that, you can do that with any vehicle. If you're only commuting from work, from your house to your job, of course your accidents are going to be more cheaper. But if you're commuting from your farm into town, your accidents are going to be more expensive because the accident's more severe because the speeds are higher. This has nothing to do with the CCs, and that relative, it has to do where you're riding the bikes.
Hi there, my name is Dallas Dornian. I just wanted to kind of comment on safety a little bit. I'm kind of a new rider, so kind of watch everybody as I'm driving around. And one thing I noticed Don kind of commented on is you could literally wear anything you want other than having to wear a helmet basically while you're riding. I literally saw a guy a couple of days ago in his gitch and flip-flops riding around. So it'd be something SGI could probably start on right away is actually enforcing some safety rules. Make guys wear gloves and jackets and pants that act, not shorts, things like that. We've all, come up to, everybody here is wearing safety gear, which is good, but the guys who aren't wearing anything at all, wearing gitch and stuff like that maybe isn't a good thing. Another thing to comment too on the CCs, something they do in Europe is instead of basing things off CC is power to weight ratio. So just because you have a big bike doesn't mean, or a big CC bike doesn't mean it's crazy fast or crazy dangerous, but you can get a 600 cc crotch rocket that's really light, that's 150 horsepower plus, and it's way more dangerous in my opinion. So something that could be looked at as well. So
Thank you for your comment.
I just want to say thank you for your comment as well. And Don talked about the collaboration with RAGE and the Motorcycle Committee, and they did bring forward some good safety improvements, and one of them was gear for new riders. And Quay's group just did some analysis on the reduction in injuries because of new riders wearing gear, and it was a 45% reduction to injury. So if gear, it was something that we wanted to mandate, not to just new riders, it could be something that brings down injury, and it is an alternative to the rate increase. So thank you for the comment.
I'll make one more comment also about CC versus horsepower, because we did hear the same feedback back when we did the motorcycle review process as well, that horsepower to weight ratio could be a better predictor of risk than CCs. And I'm on board with that being a possibility. The issue we ran into was that in Canada, on the VIN of the vehicle right now, the service we pull automatically provides a reliable source of CC, but it is not a reliable source of horsepower. And not just having a good predictor of risk, we also need a very consistent variable that we can quickly grab for each vehicle. I'm not opposed to investigating further as well in the future, so we're going to keep our eye out as well.
Hi, my name is Jason. I had a few things I wanted to touch on, but it was kind of when a lot of it's been talked about already, so I don't sound like a broken record. But one thing I wanted to bring up was the panel's word of experience. Your rates are going up because the experience you guys have seen, the records, or how the trend's been going. Well, I can only speak for myself. I'm a lot younger than a lot of riders in here, but I've been on a motorcycle for 36 years, or 31 years. I have a licensed motorcycle for 31 years, and I have never once made a claim. I don't realize why it should cost a rider like myself with that much experience, which was your guys' word, why I should be this person who has to pay for the inexperienced that ride foolishly. And like he said, horsepower, engine displacement really doesn't matter, because you can hurt yourself at 10 miles an hour or 100 miles an hour just as bad. So I just think, like I said, anybody with experience, with a good record, is really getting ripped off. And that's all I need to say. Thank you.
I just thought I'd mention, I guess it was pre-2001, we used to just charge everybody the average premium, and that's before safe driver recognition. And that was the number one thing we heard from customers is, you know, if I drive clean and I have why can't I get a discount? I want to be differentiated and charge more to those. And so that's what Safe Driver is intended to do. And so, yes, the longer you drive safe, the higher your discount, and then that applies to any vehicle you drive. So there is some differentiation there, and that applies to the motorcycle rates as well.
30 years, I get a couple $100 back? Come on.
Well, it's like 25% discount. It's pretty. Well, that one is, the Safe Driver is based on your driving record, and some of the rating is based on other risks, which is what we take into account with motorcycles.
If you want to ask a question or make a comment, please come to the mic.
I actually just want to point something out about this rate review. It is the first rate review since, 2007, where injuries and accidents, increased risk is not a play. It's rates. It's premiums. You're messed up. It's premiums. It has nothing to do with the risk. People keep talking about risk. People keep talking about engine differential. You messed up. You priced motorcycles out of the market for most people. That's what happened. Take us back to what rates were in 2012.
Yes?
I'm getting emotional, sorry. We've been talking so much about numbers and the importance of numbers and what it means to keep us riding and possibly riding in the future. The reason we're getting emotional is because this is a culture. You're affecting negatively a culture of people who love what they do. Try and work with us and come up with a solution. Get more money out of me. You get maybe $300 a year. You used to get $1,000 a year. My love for motorcycling, like everybody here, wants to continue. But if you can't do this and work with us to make that happen, it's a dying sport. It's going to be gone. That's all I want to say.
Probably what they want. So you talked about like the 25% discount and whatever. My roommate, he's got like a +10 driving record. I'm not too sure what that equals out into your guys' discount rates. He's got a brand new Harley, and he's paying almost $300 a month to plate that. I'm riding a 2007, and I'm at 0 right now, and I'm paying less than him for pretty much the identical bike, just 5 years difference. So why is he paying more? You're talking about all this discounts and that over these, whatever, good points and that. You guys are essentially saying you're doing something but not doing anything at all. You say you give us a discount, but you bring the plates up through the roof. You were literally killing a bunch of people who enjoy this as a hobby, find this as a therapeutic way to release stress and have fun. It's more than just a vehicle. And it seems like all you guys are trying to do is make sure there is no more motorcycles, get them completely off the road. It's as plain and simple as that.
Seeing no more people jumping to the mic. I would like to thank everybody for coming out tonight. I think it's a tribute to your community that you have taken such an interest in this and are willing to spend an evening when you might otherwise be out sitting in your backyard or maybe going for a ride in the fresh air. So I do appreciate you all being here. Just a couple of words about the panel's role and how this public meeting will be used by the panel. As I indicated earlier, this meeting has been recorded and it will be available to be viewed on our website, which is saskratereview.ca. As well on our website is all of the material related to this rate review, including SGI's rate application and all of the documents that go with that. Please don't try to read them all. There's way too many. And if you're like me, you wouldn't understand some of them in any event. Basically, the panel is directed by an order of the minister in charge of the Crown Investments Corporation and SGI to do a review of the rate application that's been put forward by SGI and the Sask Auto Fund. Although there are several terms in the document, basically we are to provide the minister with our opinion on the fairness and reasonableness of the proposed rate application, using a number of criteria, including what the interest of the auto fund is. Also the public, what's the interest of the public, and also the Sask Auto Fund customers. We must also consider relevant industry standards, as well as the proposed rates competitiveness with neighboring jurisdictions. Part of our mandates is to seek public input from stakeholders, from the public in general, and we have done this in a number of ways. People can comment on our website through the feedback forum. They can leave phone messages, they can send emails, and through these methods we have received in excess of 200 comments, either verbal or written, and they will also be used as part of what we look at in coming up with our report to the minister. A large majority of those comments came in from motorcycle riders and related parties such as motorcycle shops. There were also a number from the taxi group, as well as concerned individuals. Just a note, we got absolutely no response from anybody saying the application provided reasonable rates. So everybody was on the negative side of it. Our plan is to complete this review, taking into account all the responses, as well as the presentations tonight, and any further communications that we may receive up to kind of a deadline of August 29th. So there's still an opportunity for people to make their views known. They can contact us through the feedback system on our website. We will be working with our consultants. We have actually 2 different consultants working with us on this application. One is a general consultant who looks at the application from a financial point of view, looking more closely perhaps at things like administrative costs and so on, as well as an actuarial consultant. And the actuarial consultant works with many regulators of insurance rates across Canada, and she has many years of experience, so we get good information from her as to how this rate application would stack up against others that she would have seen in other jurisdictions. We have a deadline of October 20th to complete our report and present it to the minister, and we certainly intend to meet that deadline. In the meantime, you, as any individuals, can go to our website and you can monitor all the questions that have been asked and answered by SGI, by the consultants, and what the responses have been. Again, thank you for coming out tonight, and please have a safe drive or ride home. Thank you.
Can we contact the rate review panel directly, or do we have to go through the website, your website?
Well, please go through the website, and we will get back to you if you have a direct question. Yep.
Okay, thank you.